Good morning, everyone. How are we all? I'm good. So we're meeting after a long time. Right, guys? Good morning, Isha. Good morning, Sahil, Sanya, Mamta. Good morning, Abrakesh ji. How are we all? Can you hear me properly? Yes. Yes or yes. Okay. So we have covered good number of topics in the subject of advanced financial management, and today it's time for us to get started with another interesting topic, or the subject of discussion altogether. That's about the mutual funds, right? So this is just an extension of what we have observed in the topic of portfolio management, where we were trying to create a portfolio that provides us a good rate of return at an accepted level of risk, and we are also trying to calculate what should be the required rate of return for a particular level of risk in a particular security. We try to measure the risk using different techniques like the standard deviation, like the beta. Then we have got the factor betas. So many such aspects have been covered in portfolio management. Now it's time for us to take this topic, or take this concept a bit ahead in the form of more formalized portfolio management, which is essentially done by the mutual funds. Okay, so that's the thing which is done by the mutual funds. Now, let's discuss about what is this mutual fund. We'll have few numerical questions also based on this, but it's more important to understand this mutual fund from a very practical and conceptual point of view. Okay, now if I ask you what is a mutual fund, what could be your answer? If I ask you what's a mutual fund, what could be your answer? What do you understand by the term mutual fund? How do you interpret it? Yeah, guys, how do you interpret the term mutual funds? Pooling of funds to invest further. Okay, perfect. So it's like mutual fund is basically pooling of funds to invest further. Then group of securities. Okay, perfect. Group of security. Anything else, guys, that you can think of or that comes to your mind when I say the word mutual funds? What other thing comes to your mind when I say the word mutual funds, guys? Group of securities, pooling of funds to invest, right? What else? What else do you think is a mutual fund? Yes? Any other concept? Any other thing that comes to your mind, guys? What's a mutual fund? Yeah, guys? Tell me, what else do you understand by the term mutual funds? Units are allotted. Okay. 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 So let's understand what do we really mean by mutual fund and how it is established, what has been the history, right? So let's first understand the concept of mutual fund. What is it really taking to be call certain thing to be a mutual fund, right? Good morning, Jenny. Good morning, Jenny. Good morning. Okay, let's try to understand what is a mutual fund. So let's take a example to understand how this mutual fund is formed and how the trading and how the working goes around. So first up, mutual fund always starts. Mutual fund always starts with a sponsor. There will be a sponsor. The mutual fund always starts with the sponsor base. Now, who is a sponsor? Like in case of company, uh, who is responsible for establishing the company? In case of a company, who is responsible for establishing or for giving birth to a company?
Promoters.
Promoters, right? So it's the set of promoters. Like if I talk of Infosys, you have Narayan Murthy as one of the promoters, Nandan Nilekani to be one of the promoters, right? If I say Zomato, it's the Dipinder Goyal. If you say Paytm, it's the Vijay Shekhar Sharma. Right? So there are always certain set of people who come up with the idea of the company and they establish the company. Those are called as the promoters, right? Now, same way, when I want to establish a mutual fund, I need an entity which is called as a sponsor. Okay, I need an entity which is called as a sponsor. So basically, sponsor is the entity which has got some funds, and that sponsor or the fund is going to establish a mutual fund with, of course, an intention to get involved the other parties also into the mutual fund. So we have a sponsor available with us. Okay. Now, sponsor will be responsible for establishing of the mutual fund. Now, how are we going to establish mutual fund? Is a mutual fund going to be established in the form of a company, in the form of a partnership, or what is the legal entity under which mutual fund will be established? Well, mutual fund will be established by way of entity called as a trust. So in India, mutual funds are always established in the form of a trust. Okay. So, for example, if we have sponsor as SBI Limited, State Bank of India, right? So State Bank of Limited is let's say the sponsor. So they want to establish a mutual fund of theirs, and they are coming up with obviously some sort of capital contribution. So the sponsor guys are definitely going to come up with some amount of capital contribution. These sponsor will be establishing a mutual fund trust. So they will establish a mutual fund trust. So this is like SBI mutual fund, and this SBI mutual fund which is established, this is going to be, of course, in the form of a trust. Now, what is the reason, sir, the mutual fund is established as a trust? Well, mutual fund is established as a trust because the public money is involved in this. So there is a lot of money which is coming from the public which is going to be involved in this, and I cannot open it in the form of a company because this mutual fund is supposed to be working in the favor of the investors who are going to put their hard-earned money. And therefore, it is mandated that you have to establish mutual fund in the form of a trust. Okay, so SBI mutual Now, can you hear me? Can you hear me now? Yeah. Okay. So some technical error, got muted. Anyways, yeah. So we have a sponsor, something called as a SBI Limited, and then we have a SBI mutual fund, which is established as a trust. The sponsor will approach the public at large, and it will say that, see, we have got 10 crores of our investment, right? We have got 10 crores of our investment, and we want to establish a mutual fund. We want to do a collective investment scheme. Right? We can call it as a collective investment scheme. So, collective investment scheme is something we have to run. So, we will approach the public to fund us, a sum of, let's say, 990 crores. Right? So, a total sum of 990 crores is what we are asking from the public. And of course, public wants to invest in this, right? We give them all sort of scheme related document like what is the total size of the fund, where we are going to invest this money, what is the scheme, what type of investment am I going to make? Am I going to have I'm going to invest in only equity shares or debentures or whatever. With all the scheme related document, you approach the public at large with a asking value of 990 crores, with the offer of 990 crores. And when you approach the public for the first time, it is something called as NFO. Right? So NFO stands for new fund offer. So you approach the public with something called as NFO. Right? So this is called as a NFO, or new fund offer. And this new fund offer is going to be given to the public at large, and then from the public to the SBI mutual fund will be established. So the public is going to then, of course, give that 990 crores to the mutual fund trust. Right. So now the trust is having 990 crores plus 10 crores of the sponsor. So what's the total size of the fund that SBI mutual fund has now? What's the total size of the fund which the SBI mutual fund is having? It's going to be 1,000 crore, right? So this particular mutual fund is established with a investment of 1,000 crores, right? So now this money which mutual fund is having, what is it going to do? What is it going to do? 1,000 crores.
Invest in market.
They're going to invest in market, but they're not going to invest on their own. Rather, they will appoint someone called as an asset management company who's going to take care of the management activities of the investments. So SBI is going to appoint a asset management company, right? So this is like SBI Fund Management Private Limited. Okay, so we have got SBI Funds Management Private Limited. Now this is the entity which is going to be responsible for managing the funds, and this is also said to be the asset management company. It's also said to be the AMC, or asset management company. Right? So this 1,000 crores in total will be passed on to the mutual fund, or to the AMC. Right? So this entire 1,000 crores is transferred to SBI mutual funds, right? So this 1,000 crores is passed on to this AMC. Now this AMC is responsible for managing the assets, right? So let's say, for example, I'm saying, this 1,000 crores which is invested into, is given to this AMC, it makes the investment as follows. Okay. Let us say it puts into shares of Reliance Industries Limited, it puts into the shares of Infosys, it puts into the shares of TCS, it puts into the shares of, let's say, L&T, it puts into the shares of, let's say, DMart, right? Correct. So this 1,000 crore invested, let's suppose, in this 5 stocks, and of course we have some amount of cash available. So Reliance Industries is having, we invested, let's say, 200 crores in RIN, right? Then we invested, let's say, 250 crores in Infosys, suppose 150 crores in L&T, and sorry, in TCS. L&T, let's say we have got 100 crores of investment. So 450, 600, 700 is done. So another 200 crores in DMart. And then cash we have of 100 crores. Is it matching? 200, 400. It's no problem, I think. 300, 600. 100 crores of cash. Okay. So this is what the investment is made, just hypothetical numbers. So we say the total investment made is, 1,000 crores. The total investment made is 1,000 crores, right, sir? So that's your investment criteria. That's the amount which is going to be invested by the SBI Fund Management Private Limited, or the AMC, into the securities. Now, of course, if you look at one aspect, who will be owning these shares, by the way? Who will be owning these shares, guys? Who will be owning these shares? Is it the AMC who is going to own the shares? Or is it the trust who is going to own the shares?
Mutual fund trust.
Mutual fund trust, of course. The trust is going to own it. The AMC is just for managing the funds, right? So AMC is simply going to be the purpose for managing the funds. Okay. So these funds are distributed into multiple securities, and they are going to be owned by the mutual fund trust. Okay. Now there are other entities also who are going to be involved in this. So, like for example, we'll have something called as a custodian. Yeah, so we'll have something like a custodian. Then we will have registrar and transfer agent. Registrar and transfer agent. Then we'll obviously have someone called as distributor also. So these are the 3 additional persons who are going to be responsible for, who's going to be getting involved in the mutual fund segment. Okay, so what are their tasks? Let's try to understand it. Very simple. Yeah. So custodian will be the person who is going to be a custodian of these shares. Of course, these shares are owned by SBI Mutual Fund. But who is going to hold these securities? Who is going to hold this particular assets? Right. So the holding part is going to be done by the custodian. So there will be a custodian who will be responsible for maintaining a record of the shares which is held by the mutual fund or which is owned by the mutual fund trust. So custodian is going to be the holder, or basically in whose possession the securities will be there. Right. So custodian is going to be the person who is possessor of securities. So custodian is going to be the person who will be possessing the securities, who's going to be in the possession of the securities, right? So these securities are actually going to be held by the custodian. Let me just change the position. Maybe this will look better. So these particular securities are going to be held by the custodian, right? Okay. Now, whenever there is certain investments coming in, like there was an NFO and then people invested in this mutual fund, there may be a case that some of the investors would like to withdraw the money, or the some of the investors would like to buy new units, right? So then that person is going to be registrar and transfer agent, who is going to be responsible for keeping a record of the units bought and sold. And who are the distributors? Distributors are the entities, distributors are the persons who are responsible for selling the units of mutual fund to the public at large. Now, obviously, what are the units? When you are investing in the SBI mutual fund, you're giving like 990 crores. But against that, what are you going to receive? Against that, what are you going to receive, guys? From the mutual funds, what is it that we are going to receive?
It's units. I mean,
We will-
in terms of units, like equity share.
Yeah,
Not equity share, but it's units.
yeah, we will receive the units, right, guys? So we're going to receive the units. Okay, so there we find that SBI mutual fund is definitely going to give units to its investors. So units will be transferred against the amount invested, right? So units will be transferred against the amount invested to the public at large. Now, when you as an investor, you are buying the units of the mutual fund, it signifies that your part investment into the portfolio. You may be liking to, maybe sell these units back to the mutual fund, or maybe sell it in the open market, or maybe you want to receive the dividends later on. So all that track record needs to be maintained as to who is responsible for the unit transformed, right? So that activity is going to be performed by the registrar. Custodian is going to be the person who is going to hold the securities. Distributor are the persons who are responsible for distributing the dividends, distributing the units or the mutual fund scheme to the investors at large, right? So, for example, if SBI Limited is having this trust, SBI Fund Management is an AMC, then we have registrar and transfer agent. In case of SBI, we have something called as CAMS. Have you heard this term? CAMS, guys? Have you heard about this entity, CAMS? This is a registrar and transfer agent of most of the mutual funds. This is nothing but Computer Age Management Services Limited. CAMS Limited is, again, it's a listed company. So this is a company which is responsible for being a registrar and transfer agent. And then custodian, in case of SBI, it can't be SBI itself, which will be like HDFC Bank. And the other custodian is generally the Citibank. These are the custodian of SBI securities. So this entire set of structure altogether is what we call it as a mutual fund. So mutual fund is not just one SBI mutual fund, but there are a lot of other parties which are involved behind the market or behind the scene, which are working together. Right? So distributor, transfer agents, custodian, then you have the AMC, then you have the trust. Obviously, trust, if we have, there are multiple trustees in it. So this entire structure altogether is what we call as the mutual fund. Okay. Now, against this 990 crores, SBI mutual fund would be obviously giving units to the public. And of course, the SBI Limited will be also having the units of this. So whenever there is an NFO, NFO new fund offer, the units are always sold at a price of per unit price of rupees 10, right? So number of units that are sold, let's say it is 100 crores. So what will be the net asset value? So net asset value will be, of course, 10 per unit, because your total investment made is of 1000 crores, right? Total investment that you have made is 1000 crores. Number of units is 100 crores. So therefore, per unit value works out to be 10 rupees per unit. Okay. Initially, it is 10 rupees per unit, but going ahead as the business, proceeds further, as the investment activities takes on further, of course, the value of these securities are going to change. So let's say 1 month later, suppose 1 month later, after 1 month, what's the status? So after 1 month, let us say these same securities we have, right? And let's say the investment which we have made in Reliance Industries Limited for 200 crores, that has become, let's say, 240 crores. Okay. Infosys, let's say it's become 220 crores. TCS has turned out to be 225 crores. L&T has become, let's say, 150 crores. The value I'm talking of, value has changed to this extent. DMart has, let's say, become 190 crores. And we are having certain cash. We're having some amount of cash. Let's say 98 crores of cash is available with us. So this is our total assets. But wait a minute. Before that, we may have some sort of income receivable also. Maybe some dividend has been declared, right? And that has not yet been received by us. It's quite possible, right? Because when I'm investing in these securities, of course, these securities can also be providing me dividends also. So I would be looking for certain income which I'm supposed to receive. That is also an asset for me. So let's say income that we're supposed to receive is 4 crores. Right? So total assets will work out to be 1127 crores. But just as we have income receivable, can we have expense payable also? Can we have some expense payable and some liabilities pending?
Yes.
Yes, sir. Yes, of course. So we'll say from that, we're going to reduce the outstanding expenses. Any outstanding expenses? Maybe the fund manager need to be paid the salary. Maybe the staff needs to be paid the salary. Maybe some stock exchange expenses are pending. Right? Some SEBI registration fees is pending. So any sort of expense which is payable, that comes out in our liability. So after 1 month, we find that we are having an outstanding liability of, let's say, 12 crores. Right? So after 1 month, we find that there's an outstanding liability. There's an expense of which is payable of 12 crores. Right? So when that is the case, and we have like number of units to be 100 crores, right? So this is So now after that, we will obviously get the net assets. Now net assets is simply going to be 1127 minus 12 crores. Right? So that's 1115 crores net assets. And then we have the net asset value to be 1115 by 100. So NAV has become 11.15%, 11.15 rupees. So when the fund was launched, it was having an NAV of, let's say, 10 per unit. But now after 1 month, the fund is having an NAV of 11.15. So there's roughly a 11.5% rise in the NAV value of your investment. Got it, guys? This is how the net asset value is computed. So net asset value, as the name says, it's the total value of all assets minus total value of all liabilities. Got it? Is the structure and the way mutual fund functions, is that concept very clear, everyone? The structure, the way mutual fund functions, the way then the mutual fund values the units, right? That's pretty simple. Okay. Okay. By the way, can you just guess when did the first mutual fund really start in India? Yeah. Can you think of when did the first mutual fund start in India? Well, it started in the year 1964, guys. Right? And since then, we have come a long way in the mutual fund industry, because before we actually went ahead with 1991 economic reformation, it was more of like a public affair. But then after that, we have got a good number of private mutual funds also coming in, and youngsters, the new age people have also started investing heavily into the mutual fund segment, right? And they are, of course, we have been able to justify their aspirations also with new schemes and the types of schemes that we have. So all these things have evolved a lot, and right now, what's the size of mutual fund in India? Like, what is the amount of investment that is held by mutual fund? Total investment that is held by all the mutual funds in India. Yeah, are you aware of it? Okay, let me just show you something called as AMFI. This is the Association of Mutual Funds of all across India. They give you, macroeconomic view of what is really happening in the recent scenario. Okay, so AUM as per AMFI. So as on September, as of September or August 2024, if you look at the amount of investment that has been totally held, says like average net asset in INR crores. Well, as on 31st August, this is the figure, guys. This is the figure which is published by AMFI. So AMFI is Association of Mutual Funds of India, which keeps a record of all the mutual funds that we have in India. So the amount of investment which is held by mutual fund as on 31st of August 2024, that is 66 lakh 70,305 crores. This is the amount of investments which are held by the mutual funds in India. All the mutual funds are talking about. So total investment of all the mutual funds that we have is this 66 lakh 70,000 crores. It's a huge sum, right? Then this doesn't include, of course, the private investments made by the other entities, like in the private company and other. I'm just talking of the assets which are held by mutual fund. So overall assets which are held by mutual funds as on 31st August is there 66 lakh 70,305 crores. That's the huge amount which mutual fund is managing as of now, right? So it's growing at a faster pace, and the new age investors are also actively participating in the mutual funds. They're very much fab, or they're very much fancy about investments, and they're not much interested or concerned about now bank investments. They're looking for this sort of mutual fund investments, and of course they're investing into the shares also, and that's driving our Indian markets right now. Okay, guys. Yeah, so we understood what's a mutual fund, what's the amount of investment that we have right now. No, if we simply think of what are the various types of mutual funds we have, there are multiple categories of mutual fund. We'll discuss a few of them, do some questions, and then we'll discuss the other few of them at a later stage. So, if we look at the classification of mutual fund, classification of the mutual fund, there can be different bases on which you are going to classify, right? So on the basis let's say basis of functionality, right? So we'll do that functional classification. But functional classification. Okay. So functional classification wise, we can say the mutual fund can be open-ended, it can be closed-ended, or it can be even interval funds. So we may have a mutual fund which is open-ended, which is closed-ended, and also it may be interval funds. Now, what are these open-ended and closed-ended and interval funds? Now, when we have these open-ended funds, these funds are open for new subscription of units and also redemption of units. Right? So, investor, if you are an investor in an open-ended fund, you can buy the units at any point of time. You can sell the units at any point of time. Right? So you can buy the units at any point of time. You can sell the units at any point of time. Whenever you want to invest, you can go to the mutual fund, give the money to the mutual fund. Mutual fund will allot you the units and you are invested in it. Whenever you want to take an exit, whenever you want to get your money back, you can again approach the mutual fund, ask for the units redemption, and they'll give you back the money. That's your open-ended fund. Right? Closed-ended means once you have given the money to the mutual funds, they will not redeem your units again, neither they will accept any further investment from you. They're not going to accept new investment from you, and neither they are going to allow for redemption of the units till the fund matures or till the time period expires for which the fund was created. Okay, so that's our closed-ended mutual fund. So, do you find any problem with this closed-ended mutual fund? Do you find any problem? Because they say, if I'm like, for example, if this would have been a case of a closed-ended mutual fund, 990 crores collected from the public. Now the mutual fund is not open for redemption. So any investor who has invested in this, they cannot get their money back from the mutual fund. They cannot redeem their units. They cannot come back to the mutual fund and say, please take away the units and give me back the money. That's not going to happen because it's a closed-ended scheme. So do you see any problem with that? Do you see any problem with that? If the mutual fund is not allowing you redemption?
Liquidity crunch.
There's a liquidity crunch because now your investment is tied up. If the mutual fund is for 50 years, you'll have to wait for 50 years to recover your money. Right? So that's not something which is going to happen. And therefore, as per SEBI, they have mandated it. They have made it mandatory that whenever it's a closed-ended mutual fund, the fund will have to get itself listed on the stock exchange. The fund will have to get itself listed on the stock exchange for trading purpose. Can I say it is similar to that of equity shares? Like the company issues equity shares, but if you go back to the company and say, please take away the equity shares and give me back the money, the obviously company will say, no, sorry, we can't do that because you will have to, if you want to get your money redeemed, you'll have to go to the market, sell the equity shares in the market and get the money. So that same principle is applicable even in case of closed-ended mutual funds. Okay, so closed-ended mutual funds are obviously going to be listed on stock exchange. Closed-ended mutual funds are mandatorily going to be listed on stock exchange. So anyone who wants to get away or anyone who wants to redeem the units, they cannot redeem it from the mutual fund, but then they can obviously approach the stock exchange and ask the stock exchange to get the things listed out. Ask the stock exchange to get the things listed, and you can simply approach the stock exchange that I want to sell the units. You can sell the units. There will be a buyer in the mutual fund, right? There will be a buyer on the other side. You will sell the units and receive your money from the market itself. Okay, so that's your closed-ended mutual fund. In case of open-ended, there is no need for any listing on a stock exchange, for a simple reason that you can take these units anytime to the mutual fund and ask for redemption. If you want to buy additional units, you can also buy additional units, right? Without asking for anything else. You can simply pay the money, get the units at the existing prices. Then we have something called as interval funds. Now, what are interval funds? What are the interval funds, guys? Interval funds are, typical those funds where you can buy and sell the units at pre-specified intervals, like at the end of every month or at the end of every quarter, right? So interval funds, like during that one particular month, no buying and selling of units is allowed. After 1 month has lapsed, at the end of the month, now you as an investor can go back to the mutual fund, get your units redeemed, or maybe buy additional investment if you require. Now, of course, interval funds are not required to be listed on a stock exchange because investors have the option to exit from the scheme at a regular interval, right? So, where is it mandatory to get the shares listed? It is, of course, the closed-ended fund, which are required to be listed on a stock exchange. Okay, so closed-ended funds are required to be listed on a stock exchange. The other two are not required. Okay. Then the other classification which we can make for mutual funds is based on portfolio. Portfolio-based classification. Okay, so what all types of classifications do we have in the portfolio-based classification? Well, in portfolio-based classification, we may have like the equity funds, we may have the debt funds, right? Then we may have certain cost of some special funds also. Okay, so we have got equity funds, debt funds, and some of them special funds. Now, as the name says, since it is an equity fund, your major investment is going to be into the equity shares. Right? Majority of the investment is going to be into the equity shares. Now, even in equity funds, we have got further classifications as growth funds. Then we have aggressive funds. And then we have income funds. So in equity funds, we have got growth funds, aggressive funds, and income funds. Now, what do you mean by growth funds? Growth funds is basically those, the mutual fund invest in those securities where you are not going to, get immediate return, but they are going to be providing you appreciation, long-term capital appreciation is what is promised over here, right? Whereas on the other side, income funds are those funds where investments are made into those securities where you keep on receiving continuous income, like in the form of dividends. Right? So high dividend paying stocks, when you are choosing for your portfolio, you will be categorized into the income funds. Right? And aggressive funds is basically they try to do make up investment in the startups, in the IPOs, in the speculative shares. Right? So these aggressive funds are the funds which are promising you a very high rate of return based on, of course, higher risk involved in that. Okay, so these are the equity funds that we have. In case of debt funds, you may have the bond funds, right? Where you're going to invest in the bonds and debentures of the company and also government bonds, right? So these are the funds which are investing into the bond funds. Now, again, there are various categories of bond funds also, where you want to go in corporate bond funds or government bond funds or short duration funds or longer duration funds or moderate duration funds, ultra short duration funds, right? So there are classification based on the tenure for which you're going to invest, tenure for which a mutual fund is going to invest in the bonds, right? We may have something called as gilt funds also. What are gilt funds? Gilt funds are basically those funds which are going to invest in the government securities, right? Then we have the special funds. In case of special funds, the first fund that we have is index funds, guys. Index funds means they are going to invest in the index securities, like for example, Nifty 50 or Sensex or BankX or Bank Nifty. So these index funds are actually trying to replicate the investment of an index, right? So they try to replicate the index, like whatever Nifty 50 stocks are there, whatever stocks we have in the 50 shares of the mutual fund, 50 Nifty stocks, we are going to invest in those in the same proportion as the index has. Then it's called as an index fund. Then we may have certain international funds also, where the money collected from the investors is going to be invested into the international companies or MNCs, right? Some of them may be offshore funds. These are the funds which are raising money from outside India to invest in India. Then you may have sector funds where the funds are going to be diverted towards one particular sector, right? Then we have something like money market funds. Money market funds is like the fund which makes an investment into money market securities. Now, what are money market securities? Money market securities are like treasury bills, certificate of deposit, commercial papers which are issued by the high-rated corporates. Right? So these are some of the special funds. You may also have something called as fund of funds. Fund of funds, because we have a mutual fund which is going to collect money from the public, and it is going to invest, in the units of the other mutual funds. Right? That's called as a fund of funds, where the investment is going into the different fund of funds category. Then we have something called as gold funds. Gold funds is basically the investment made by you is invested into the gold and gold related other instruments, right? So these are generally traded as ETF or gold exchange traded funds. You may have something called as quant funds also. These quant funds are basically working on a data-driven approach for stock selection and investment decision, where the trading or investing is happening based on a sound degree of resilience in statistical models, mathematical models, quantitative models are used to choose the stocks and to also look for timing for entering the stock and exiting the stock. So here the investment is done primarily on the basis of heavy reliance on the quantitative analysis. Okay, that's your quant funds, guys. Then we have something called as capital protection fund. Now, this is something really interesting. Are you aware of this capital protection fund, guys? Ever heard this term? Capital protection fund. Ever heard this term that there is some mutual fund called as capital protection fund? Yeah, that you can also create a portfolio which will be protecting your capital. Have you heard of this? No? Okay. Let me just give you an example for this capital protection fund and what is this strategy all about. So suppose investment is of, let's say, 1 lakh. So you're making an investment of 1 lakh. This is your capital. Essentially, this is your amount of capital that you're putting in. Now, capital protection means we want to protect our capital, right? And we want to be sure that the capital that you're putting in, that is intact, even if the market goes up and down, right? So how is that really going to happen? So let's say investment horizon your investment horizon is, suppose, 3 years. Okay. So investment horizon is like 3 years. We are going to invest our money for 3 years. And of course, at the end of 3 years, I don't want any sort of reduction in my capital, right? So what will I do is, out of this 1 lakh rupees, I will put a portion of that money in the risk-free securities. I'll put a portion of that money in the risk-free securities, and the other portion will be invested in, the market. So let us simply understand what is the risk-free rate of return. The risk-free rate of return as of now, which you can get, is somewhere moving around 7.5%. So what we do is, we first calculate present value of capital at risk-free rate. So what will be the present value of this 1 lakh guys today? If I'm talking of 7.5% to be the rate of return, if risk-free rate is 7.5 lakh, and this is a capital which we are going to invest for, let's say, 3 years, and after 3 years also I want to be sure that I'm getting at least 1 lakh rupee in my funds, in my capital. So can you tell me what will be the present value of capital at risk-free rate? 1 lakh.
80,496.
80,496. Okay, let me just check it. It will be simply 1 lakh divided by 1 plus 7.5% to the power of 3. So 80,496. This is the amount of present value of the capital that we have. Okay. So the distribution is like 1 lakh will be invested in 80,496 in risk-free securities. Okay. And do we have any surplus funds after an investment is made to the risk-free securities? Like 80,496 is going to be invested in risk-free securities. And of course, the balance, which is 1 lakh minus this, will be invested in the shares. Right. So this particular amount of 19,504 will be invested in the shares of the company. Right. So once we have taken away, once we have done this bifurcation, now the next task would be, after 3 years. After 3 years, what's going to happen? Value of risk-free securities. What will be the value of risk-free securities, guys?
1 lakh.
Can I say, because you have invested the present value of risk-free securities, this 80,496, if you just consider the tax way also, like 80,496, that will be, of course, growing at 7.5%, right, for a period of 3 years. That will be remaining 1 lakh. So your capital is protected, where the amount that you initially invested, 1 lakh, that is not going to, that's a bare minimum amount which you're going to realize from it. This is sure. This 1 lakh rupees is, something sure. Then we look at value of other shares. So the 90,504 that you have, the amount that you invested, that will be having some value over here. Maybe that 19,504, even if it becomes 0, what will be the total redemption? Can I say 1 lakh? Total redemption will be a bare minimum 1 lakh, right? Total redemption will be a bare minimum 1 lakh. And as the value of securities increases, like we have invested 19,504, if it turns out to be like 25,000, total redemption will be 1,25,000. Okay. Total redemption is going to be 1,25,000 if the value of redemption becomes 25,000. If it is 30,000, that will be going to 1,30,000. So this is like we are making sure that our capital of 1 lakh is protected. And over and above that, whatever we are earning, that's added to the total redemption value. Okay. Fine. So that is the total redemption, or that's the capital protection fund or the capital protection scheme that we are talking about. Is this clear, guys? Capital protection scheme, yeah. Okay. Some of the other categories that we have, the other funds would be types of, there are various schemes. So as far as funds are concerned, which are broad classification is this, but under these also you may have different types of schemes also. So some of the schemes of mutual fund that we have, types of schemes. First one that we have is balanced funds. So what do you mean by balanced fund? This make an investment in equity and debt, both ways. So we make an investment in both areas where we are having the investment made in equity shares as well as the debt. So you're actually trying to diversify your risk. You're not purely investing into the risk, but not purely into the debt. So you're creating a balanced portfolio of both of them, right? Then we have diversified equity schemes also. So diversified equity schemes also we have. Some of the examples of diversified equity schemes are, large cap investments. Large cap means the mutual fund is going to invest heavily into the large cap securities. You may have mid cap funds where the investment is made in the mid cap funds or mid cap shares. You may have small cap funds also. You may have multi cap also. The multi cap means the criteria is over here to call any fund to be a multi cap. We say minimum 25% in large, mid, and small. So you need to make a minimum of 25% investment in the large cap, mid cap, and small cap. So total 75% is what we are coming up, right? So we have this total 75% which is coming up. If you just consider this 25% limit for all three of them, the rest 25% is at the discretion of the mutual fund where to invest and where not. Okay, so that's your diversified equity funds category, multi cap. Okay, we may have also something called as flexi cap fund. So this flexi cap fund is essentially for there is no criteria as such where they are going to invest, like large cap or small cap or mid cap. They can invest at their own their discretion without any restriction. They can invest in the large cap, mid cap, or small cap, depending on the return generation potential. Okay, based on return generation potential, they can have their own flexi cap funds also. Okay, then we have something called as contra funds. So there is this investment strategy. We have this investment strategy called as contrarian investment, where it's an investment strategy where the manager invests in securities which are not in favor of the overall market. Like entire market is selling that security, but these fund managers are going to buy those securities because they believe in they believe that particular stock or that particular investment is going to take a turnaround in few years, right? So whenever they say you're going to invest in out of favor companies with an expectation that they're going to outperform the market, they're going to perform really good in long run, that's your contra funds. Then we have dividend yield income funds, as we already know. There are schemes which gives you an option of growth or dividend. So that is like what we have covered over here: growth funds and income funds, right? So growth is basically where the mutual fund is not going to give you any sort of dividend paid out. Rather, they would be whatever dividend they receive, they would be investing in the new securities, right? But in certain cases, that mutual fund may also give out dividend, or they may pay out dividend to their investors also. Okay. Now, under dividend scheme also, they have got two options. Either you can distribute the dividend in cash, or you can ask the unit holders to take additional units against the dividends. So they may ask you to take additional units against the dividend. So that's your dividend reinvestment scheme. Okay. We may have certain funds also which are specific to a particular sector, or we may have certain funds which are looking for arbitrage also. Certain funds which are called as hedge funds, right? Exchange traded funds. So these are some of the mutual fund categories that we have. Okay. We may have also something called as thematic funds. Thematic funds is basically you're looking for a particular theme, not a very broad, not a very narrow area at sector, but you're looking at a broad category of themes. Like for example, green funds. We can have some concept called as green funds, because the recent days we are more concerned about something called as ESG. ESG is basically environmental, societal, and governance. So these three are the key areas where the focus is right now all across the globe, right? So if you have a theme like we want to invest in those companies which are following the ESG philosophy, so that is again becoming like a thematic fund. It becomes a theme. So those companies which are environmentally sensitive projects, which are socially very sound enough, or those companies which are having a very high degree of corporate governance standards, when you invest in those securities, it becomes a thematic funds where you're targeting the ESG segment. Okay. Then beyond this thematic funds, rather this all comes under the same category, which is diversified equity funds. You can say thematic funds. Then we may also have something called as real estate target fund or real estate sector fund, where the fund is collecting money from public at large and investing into the reality sector, basically investing in the shares of the real estate companies. And we may also have something called as REITs, real estate investment trust, right? So REITs or real estate investment trust, these are the funds where they're going to collect money from the public and they're going to invest in the real estate projects. So whatever income is going to generate from those real estate project management, you will get that money, lead to the equity appreciation, and of course you can later invest it at a you can obviously later pay out the dividend and distributions to your investors, right? So these are some of the funds that we have in the market, and there is this broad category of investment matching your risk and return profile. So as an investor, if you want to gain access to this, you can choose from a wide array of funds that you have. You can have a look at, if you are really interested in taking lesser risk, you can choose for a large cap stock if you want to get yourself exposed to equity. On the other hand, if you want to have a debt exposure, where you want to say that I don't want to invest in the equity, but I want to rather invest in the debentures, then you can of course look for the debt schemes also, debt oriented schemes, right? So there are multiple such schemes which are available in the market for investment purpose of based on the risk return requirement of every investor. Now the question arises, why mutual funds? Why should we make an investment in a mutual fund? Why can't we simply go ahead and buy the shares and debentures on our own? Let's create a portfolio on our own. Why should we go to a mutual fund, right? So I recently just asked one of my students, where I just asked him that, because all of us are now into this investment area, because in the recent last 1 week, one or 1.5 weeks, you can say, the markets have actually been taking a sort of bearish trend. So I just asked him, how's your portfolio doing? Okay. So he said, as usual, sir, market is not in our favor, so my portfolio is down. Then I asked him, where do you invest? Which are the securities that you invest? He said, I choose my own stocks, sir, and I invest there. And I also do have mutual funds in my portfolio. I said, that's interesting. So I asked him, what's the position of your equity scheme or equity portfolio which you have created on your own? So he said, it's down by 30%. Sir. So what did he say? That the fund that he has created, the mutual fund, not the mutual fund, but rather the portfolio which he has created on his own, based on his own analytical skills, based on his return, he said, sir, it is 30% down. So he's made a loss of 30% in the portfolio created by him. Now then I asked him, what about your mutual fund? He said, sir, mutual fund is down by 7%. So the idea is, when we look at self-managed fund, his portfolio was down by 30%. Whereas the mutual fund in which he has invested, that is down by 7%. So that's where, the edge or the competitive advantage of mutual fund comes in. And if you look at why mutual funds, it has got multiple advantages. The first advantage of you investing in a mutual fund is professional management. So you are undertaking the management of your money. The fund manager, the AMC, is going to manage the portfolio in the best possible analysis, best possible way, because they are backed by sound research. They have sound information about the securities. They have good information about the shares, the debentures. They have good information about the companies. So they can actually take position in the securities based on their sound research. Right? So that's the first point or advantage that we have, which is professional management. Second aspect is diversification. As an investor with a capital of maybe 1 lakh or 5 lakh or maybe 10 lakhs, you can get yourself exposed to limited number of securities. And you may not be even sure whether those securities are really going to meet your expectation or not. But that diversification benefit is possible in mutual funds, because mutual fund would be investing in hundreds of securities. Right? Third advantage is convenient administration. Okay. So third advantage that we have is convenient administration, because all the buying and selling of securities are taken care. Buying and selling of securities are taken care by the share transfer agent, custodian. So we as an investor are not concerned about where the money is going to get invested or how the funds are going to be transferred. So those are not going to be our headache. So headache will be with the mutual funds, and that administration is taken care by mutual fund. And then we can look for another advantages, higher returns. Higher returns at, you can say, lower risk. Because as compared to you investing in 5 securities, it's better to invest in a mutual fund which have got 500 securities, right? Because they can generate good return because of the sound research and also, of course, years of experience which the fund managers bring in, right? So you can generate that high level of returns as compared to individual investment also. But yes, if you are sure that you can manage your portfolio well, better than the mutual funds, you can do that. But in general sense, I'm talking of that, being a very naive investor, being a very new to the market investor, you may not have that expertise in choosing the stocks, not only choosing the stocks, but rather deciding on the time when to enter the market and when to exit it. That is the skill which the fund manager has got, right? And then we say low management cost, right? So low management cost means the fund managers are of course going to charge certain fees for managing your fund, but there is a cap on which there is a maximum cost or maximum expense which the mutual fund can actually claim. It cannot say a very huge amount of cost for managing the funds, because SEBI has simply prescribed that a maximum limit for charging the fund management fee to be 2.5%. Right. So as per SEBI, the maximum is 2.5%, which is the expense ratio. Right. So no mutual fund can actually charge you more than 2.5% of the investment, 2.5% of the AUM as a management fee. Of course. The second thing is, you get a liquidity. You get access to the liquidity because there's a lot of liquidity involved in it. Whenever you want, you can buy the units and you can sell the units. So that way it provides a good amount of liquidity. And the next is like, transparency, because this SEBI is heavily involved in it. Moreover, we have some of the regulatory enterprises also. So there is self-regulatory entities like your MP, which are regularly are supposed to be taking a record or keeping a track record of how the mutual funds are performing, and they of course take reports from them, right? So the SEBI is now actually putting a compulsion on the mutual funds to disclose their portfolios on a half-yearly basis. So every half year, what are the portfolio of the mutual fund, right? Of course, transparency due to the high regulation, and most important thing is economies of scale. Because the mutual fund work in so heavy volumes, the expenses, the transaction expenses, like your brokerage, like your transfer fees, like the other stock exchange fees, those are very much negligible. If you compare what is being charged to you, that's very lower amount as compared to what you would have to incur if you're managing the funds on your own, right? So now this particular mutual funds are providing this sort of benefits at a very convenient, because you can do the investment in the units by any of these apps. You have your Zerodha app, you have your Navi, and then you have Grow. So there are a lot of apps which are coming up, through which you can easily open your Demat account and start buying the shares, or maybe even the mutual fund units also. You can apply for mutual fund units even through your banking portals, right? So that investment in mutual fund has become a pretty easy task as of now, because not much paperwork is required. Like, you can get your Demat account and mutual fund investment within a span of just 24 hours, right? Your account gets activated within a span of 24 hours, and you can just start investing in it. Okay, so but of course there are certain disadvantages also, right? So there are certain disadvantages also which you can look for. Now, what could be the set of disadvantages that we can think of from a mutual fund? Of course, when you're investing in a mutual fund, you might have obviously heard those line by any mutual fund advertisement where they say that mutual fund investments are subject to market risk. Please read the scheme related document carefully before investing. So it's a disclaimer which the mutual fund gives to you, that it's not necessary that if you're investing in a mutual fund, you'll be able to generate a huge return out of it. So there is no guaranteed return. Right? So there is no guaranteed return. That's for sure. So it's like, mutual fund cannot give you a guarantee that you will generate a bare minimum of this amount of return. That's not possible. Right? So there's no guaranteed return as such. Then second is, if you look at the diversified portfolio, of course, you can reduce the risk, but it's quite possible that diversified portfolio may not give you that exceptionally good return also, right? So it's quite possible, you may get low return due to diversification also, right? So due to diversification, because the mutual fund is investing in securities where the return is moderate thing, and you are creating a portfolio of securities. So the potential which you had by investing in one or maybe few securities where it would have returned, it would have given you higher return. That's not possible because of diversification. And the third confusion comes is, sometimes we as investors are confused. What is our objective? Do we want to take high risk and high return? Of course, if you talk to me about high return, of course, I want to be. But are you ready to take the high risk? That is something which we are quite skeptical about. So that way, it's possible that you can, select selection of improper schemes. There may be multiple schemes that we have already discussed. Out of that, which scheme really suits you? The selection of that is something very crucial when it comes to performance of the mutual fund. And of course, the last criteria that we have about mutual fund is the cost factor. There is always this cost factor coming in, because as an investor, you will be bound to bear certain, or as an investor, you'll have to face certain costs of the mutual fund also. Now, when it comes to cost, you have like few things. Something called as entry load, and we have something called as exit load, and then we have something, we have an entry load, exit load, and maybe also management expenses, management fees. So what are these three things that we should really be aware about? First, entry load is the amount which is charged by mutual fund when you want to make an invest in its scheme. Okay, so at the time of you entering into the scheme or you buying the units of the scheme, the entry load is charged on the investment. Like whatever investment you make, out of that certain portion will be kept by the mutual fund aside for meeting its initial expenses, and of course that goes to the common pool. That entry load is subtracted and the net amount is only invested. So the charge or the fees that you pay at the time of entering the investment or at the time of buying the units is called as entry load. Exit load is the fees that you pay when you are going to take an exit from the mutual fund or when you want to redeem the units. Remember, exit load is not applicable if you are going to sell the units in the market. If you are going to sell the units in the market, exit load is not applicable. Like in case of closed-ended fund. In closed-ended fund, if you want to realize the money, you have to go to the market and sell it there. So when you're going to sell the units in the market, there's no exit load which is applicable because it's just like sale and purchase of any equity shares. Exit load is applicable in case of open-ended scheme. Right? So in case of open-ended scheme, when you want to go to the mutual fund and return the units back to the mutual fund for redemption, that's where we say exit load will be charged to you. And of course, management fees is something which is charged by the mutual fund for meeting its expenses and also to pay salary to the fund manager, right? So those particular aspects are taken care of in the management. Okay, so and the most crucial part, what I say is, SEBI has anyways banned or it has mandated no entry load can be charged. So none of the mutual funds you will find they are charging you any sort of entry load. Okay, but yes, of course, there is something called as distribution expense, which I'll come to that later on. But entry load is something which is not charged as of the SEBI regulation. Exit load is chargeable, but even in case of exit load, mutual funds have specified that if you continue to be invested in our business in the fund for a longer duration, maybe for a year, maybe for a 2 year or 3 year, they set the limits. So every mutual fund is free to take a call on that. What should be the time period or lock-in period for which the exit load will be applicable. Beyond that, there won't be any exit load. Like if a mutual fund has stated that lock-in period is, let's say, 3 years. So if you're going to redeem the units before 3 years of your investment, exit load is applicable. Whereas if you're going to redeem your investment after 3 years, exit load may not be applicable. Right? So out of this, whatever thing goes as this is like a management fee. Now, when we have, there is something called as distribution expense, and due to that, you will find there is something called as a regular scheme regular scheme of mutual fund, and there is called as also direct scheme. So regular scheme and direct scheme is something that's there. Now, what do we really say about regular scheme, regular and direct scheme? Like, if I want to buy the units of a mutual fund, I can either make an investment directly into the mutual fund, directly fill up the mutual fund form and submit it at the office of the mutual fund, or you can even apply to them through the online portals. But there is something called as, apart from this is what we said as a direct scheme. The regular scheme is when you go through the mutual fund agents. So there are agents, there are distributors who are responsible for marketing, who have the rights to market the units of the mutual fund. So that's your regular scheme. Now, if you look at these things, like for example, if you are making an investment, if you're making an investment of suppose 100 rupees, under the direct scheme, entire 100 rupees goes into the mutual fund. But when it is regular scheme, from that, certain initial expenses will be paid as commission to the agent. So maybe 99.5 will be only invested. So 0.5% or maybe 99. So 1% is the commission which is paid to the distributor, right? Which is paid to the distributor. And of course, this particular regular scheme will be having, the 99 getting invested into the mutual fund. That 1 rupee difference is paid to the mutual fund distributor. So obviously, if I ask you which of these two schemes, are going to have a higher net asset value, what do you feel? Which of these two schemes will have a higher net asset value?
Direct scheme.
Direct scheme? Is
Yes.
it? Yeah. So we'll find that these mutual funds, if you look at the type of thing, there are like direct and the regular. So we'll find that the direct scheme is supposed to be having a higher NAV for a simple reason that regular scheme takes away some portion of your money as a commission towards the mutual fund distributors. Now, these mutual fund distributors, whether it's a regular or direct scheme, or especially a regular scheme, sometimes they would like to get their investors confidence that please stay invested in the mutual fund scheme, and due to that, they are also paid something called as trail commission. Trail commission. Now, what is this trail commission? Trail commission is simply, if let's say one of you buys a mutual fund from me, I being a mutual fund distributor. So till the time your investment is with that mutual fund, the mutual fund will keep on giving me some sort of commission. And that commission may range from 0.3% to maybe 0.75% per annum. And this is per annum of AUM. Or you can say of the NAV. So it is going to be this much percentage of your NAV which will be given to the distributor, because that distributor is actually enabling the mutual fund by convincing the investor that to stay invested in it. So as a mutual fund distributor, I will be getting this trail commission based on the fund value. And the moment you withdraw the money from the mutual fund, I will stop receiving that commission. The moment you withdraw the money from the mutual fund, I'll stop receiving the commission, because trail commission comes to an end at that point of time. So as a mutual fund distributor, what am I really earning? I'm earning the initial, the commission for bringing the customer, bringing the investor to the mutual fund. Second, you would also be getting this trail commission every year to keep your investors intact, invested in the particular mutual fund. Okay. Okay. Now, Now let's look at one of the questions before we go for other aspect. Yeah, let's try to look at this particular question number 1. We'll do some practical questions now, and then we'll of course take up some more conceptual things also. So let's come to this question number 1, everyone. So Mr. A can earn a return of 16% by investing in equity shares on his own. So this Mr. A is confident that he can earn a return of 16% if he does the investment management on his own. Now he's considering a recently announced equity-based mutual fund scheme in which initial expenses are 5.5% and annual recurring expenses are 1.5%. So it's like 16% is what you can earn on your own. Now you're considering an investment where initial expenses will be 5.5%. So basically, whatever investment you make, out of that 5.5% is gone. That will be taken away by initial expenses. You call it as entry load, you call it as distribution fees or whatever. And the annual recurring expenses are 1.5%. So every year, the fund management fees, which the manager is going to charge, is 1.5%. How much the mutual fund should earn to provide Mr. A a return of 16%? So, of course, we have certain facts over here. First is personal earning of Mr. A. He can earn on his own 16%. And we have like information about initial expense. Initial expense is 5.5%. Initial expense for investment in mutual fund is 5.5%. The recurring expense or day-to-day expenses stand as 1.5%. Annual recurring expenses are 1.5%. How much should the mutual fund earn to provide Mr. A with a return of 16%? So what should be the rate of return that mutual fund should be providing so that you can earn this 16% return, right? So now if I ask you, if rupee 1 is invested by Mr. A, suppose if 1 rupee is invested by investor A, what will be the investment or what will be the amount of investment? What will be the amount of investment made by mutual fund in the portfolio? If suppose 1 rupee is invested by Mr. A, can you tell me what will be the amount of investment that will be made by the mutual fund in the portfolio? For 1 rupee invested, are they going to invest that entire 1 rupee into the portfolio?
No, after deducting 5.5% initial
5.5.
expenditure.
Yes. So what will be the investment that will be made? Can I say 1 minus this 5.5%, or I can say 0.945 will be the investment that will be made. Now, we as an investor want 16% return. Do we need 16% of 0.945? Because if I would have invested, I would have made my 1 rupee 1.16 at the end of 1 year. Right? So when you say personal earning of Mr. A is 16%, that essentially means that rupee 1 of today will be made how much? Rupee 1.16. 0.16 in year 1. Correct, guys? 1 rupee invested today is going to become 1.16 in year 1. Right? So rupees, I can say rupees 1 of today, rupees 1 of today will earn rupees 0.16 every year. Correct? So 0.16 is basically which I'm going to get. Right? Or will get rupees 0.16 in year 1. So 1 rupee invested today by the mutual fund, the actual investment that is going to be there is 0.945 plus. The actual investment that will be made by mutual fund in the portfolio is just 0.945. Now we want this 16 paise on our on as a return for us, right? So what should be the return that should be generated? Return to be generated by mutual fund. Return to be generated by mutual fund to earn 0.16 in year 1.
0.16 divided by 0.945.
Perfect. So it should be like 0.16 divided by 0.945. So we can say this is going to be like 16.93%. We can say essentially we should be having 16.93% return generated on this. So return to be generated by mutual fund generated on this 0.945. We can say it is 16.93. But wait a minute, we have a recurring expense of 1.5%. So if you generate this 16.93%, out of that you are going to pay 1.5%.
Plus 1.5 we have
So
done.
can I say we'll have to earn this 1.5% also additional. Correct? So it will be 0.16 upon this, and also additionally we should generate 1.5% also. This is like plus 1.5%. Right? So what should be the return that should be generated by the mutual fund? That should be 18.43%. That should be the 18.43%. Right? So this is what we have done logically. If you look at how do we get it simply by way of calculation, we can say return of mutual fund will be 1 upon 1 minus initial expense into return that could be generated at your personal level plus your recurring expenses. So like in our case, you can simply do the calculation 1 upon 1 minus 0.055 because 5.5% is the initial expense. So you multiply it with like 0.16 plus 0.015. That will give you the same answer, 18.43%. Right. So that's how we calculate the return that should be generated by the mutual fund. Return that should be generated by the mutual fund so that it matches the Mr. A's required return of 16%. Okay. So because out of this 18.43%, 1.5% will go as the fund management fees. The rest that is generated is 16.93, but that 16.93 is going to be a percentage of 0.945. So this percentage of 0.945 is equal to 16% of 100. Okay. Is this question clear, everyone? Yes?
Yes, sir.
Okay, fine. So let's go for the second question. The unit price of an equity linked savings scheme of a mutual fund is rupees 10. Public offer price is 10.204. Redemption price is 9.8. So we want to know what is the front end load and what is the back end load. Front end load and back end load is nothing but the entry load and the exit load. It's the same thing. Okay. So over here we have the NAV of the mutual fund to be 10. NAV of the mutual fund is 10. NAV of please say NAV is 10 rupee. But we are selling this unit to the public at large at a price of 10.204. So we have like public offer price of 10.204 and redemption price is 9.8. Right? So we want to know what is the entry load and what is the exit load. What's the entry load and what will be the exit load? Now, a simple way to calculate this is amount wise, we can say entry load as far as amount is concerned, it will be 10.204 minus 10. Right? So entry load is simply 0.204, right? So this is 10.204 minus 10. So the entry load works out to be 10.204 minus 10, which is 0.204. So entry load is 0.204 as far as amount is concerned. But if I want to calculate it as, entry load in terms of percentage, what is the entry load in terms of percentage? In terms of percentage, that will be computed as 0.204 on an investment of 10.204. It's like when you want to buy the investment, you need to pay 10.204. So what proportion of your investment is getting carried away with the entry load? That's 0.204 divided by 10.204. So that's like 1.99%. Right? That's 1.99%, or let's say you can say it's around approximately 2%. Right? So from this, we can actually make up with a particular formula. Well, the formula is like public offer price, or we can say NAV of the mutual fund scheme will be whatever is the public offer price. From that, you are going to reduce the entry load or the front end. This is a simple formula that you can think of. So net asset value will be computed as public offer price into 1 minus entry load, or you can also say that that public offer price is to be computed as NAV upon 1 minus the entry load. Okay, so that way also you can understand it. Public offer price is NAV upon 1 minus entry load. Okay, then we have this redemption price of 9.8. Like every unit of mutual fund is having a NAV of 10 rupee, but when you are going to redeem, the mutual fund is not going to give you the 10 rupee as the redemption value. The other mutual fund is going to give you 9.8. So in that case, you can say exit load that we have, the fund is having a NAV value of 10, but we are going to receive only 9.8. So this is going to be 10 minus 9.8, which is 0.2. Okay. So this is the exit load that we have, 0.2. But if we talk of exit load in percentage format, exit load in percentage form. क्या होगा? What will be the exit load in percentage form? What will be the number? Of course, it's going to be 0.2. But what should I really divide this by?
10.
Should we divide it by 10? Or should we divide it by 9.8?
10.
It will be with 9.8. It will be with 9.8. Reason is, when you were calculating the entry load, you were dividing it by the public offer price, the amount which you are paying. So you will be paying like 10.204, right? So the charge that you were being charged, that charge was divided by 10.204. Right? The charge was basically divided by 10.204 because that was the amount which you are going to pay. Now here also, when we say exit load, this is going to be again percentage of the amount of cash that you are going to receive. So how much are we going to receive? We are going to receive 9.8, right? So as we are going to receive 9.8, we will say that it is divided by this 9.8, or we can have a formula as redemption value is to be taken as NAV divided by 1 plus exit load. Right? So redemption value is 9.8 is equal to NAV is 10. You divide it by 1 plus the exit load. Right? So exit load, we can say it can be computed as 10 divided by 9.8 and then minus 1. So that's like 2.04%. Okay, so you can simply compute this formula where exit load is going to be computed by this format. So exit load will be 10 divided by 9.8 and then minus 1. Okay, so this particular formula we need to take into account. One is about this public offer price is NAV divided by 1 minus entry load, and redemption value will be NAV divided by 1 plus exit load. Okay, so always keep a note of it that these two are the formula that we need to have. Public offer price will be NAV divided by 1 minus entry load. Redemption value will be NAV divided by 1 plus exit load. Okay, guys. So that's how we compute the entry load and exit load numbers. Now, let's do one thing. Let's take a break. Okay, so let's take a break of 10 minutes and then we'll come back and take it forward with more concepts and the questions. Let's take a break, guys. Okay, welcome back, guys. So we have done a couple of questions. Let's go for a few more questions. Question number 3, guys. Let's try this question number 3. A mutual fund that had a net asset value of ₹20 at the beginning of the month made income and capital gain distribution of 0.375 and 0.03 per share respectively during the month, and then ended the month with a NAV of 20.06. Calculate the monthly return. Now, so mutual fund was having a NAV at the beginning of the month to be of ₹20. And during that month, it has given away the distributions. Distribution means it has given out the amount. It has made certain income, maybe in the form of dividends, and a portion of that dividend is being distributed as 0.0375. And 0.03 is the capital gain that the mutual fund has made, and that income is also being distributed. We want to compute the monthly return. Now, of course, it's pretty simple to calculate this monthly return, because return of a mutual fund, it's simply computed as NAV in month 1 minus NAV in month 0, right, plus distributions divided by NAV 0. Right, so we can do the calculation over here. NAV in month 1 was 20.06 minus NAV at the start, it was 20, plus distributions have been 0.0375 and 0.03. 0.0375 plus 0.03, and this is obviously divided by NAV 0, which is 20. So if we calculate this, works out to be 20.06 minus 20 plus 0.0375 plus 0.03, that divided by 20. So yeah, so percentage wise it's 0.64%. You can say per month. And if I want to talk of what's the return on a annual basis, I can simply say that this multiplied by 12 should give you the percentage per annum return, which is 7.65%. This assignment is not loaded on BS portal. Is it? I think I have done it. Check the portal again, because I think I have uploaded it. Okay, anyways, these are the questions from our study material itself. So you can access it from there also. Okay, so question number 4. An investor purchased 300 units of a mutual fund at 12.25 per unit on 31st December 2009. So this is a mutual fund investor who bought the units at a price of 12.25. As on 31st December 2010, he has received like 1.25 as dividend and 1 as capital gain distribution per unit. Return on the investment, if NAV as on 31st December is 13 rupees. Return on investment if all dividends and capital gain distributions are reinvested into additional units at a fund in the offer fund at 12.5 per unit. Okay, there are 2 areas over here. One is, pay attention guys, one is where the distributions are made to the investors in the form of cash. And second area is when the distributions are reinvested in the form of units. Right? So return for the year, we have to compute it from two angles. So first angle is like, let's compute the return similar to the previous question, where the return on investment, we can calculate the return on investment whenever the distributions are made in this pattern. So this is like NAV for year one or month one rather. Year one, it is 13 rupees minus starting NAV was 300 units at 12.25. 12.25. To that, we will add the distributions. So distributions are like 1.25 and 1. So we'll add 1.25 plus 1 and the entire thing divided by 12.25. So if the distributions are made in the form of cash, then the return of mutual fund will work out to be 13 minus 12.25 plus 1.25 plus 1 divided by 12.25. It's 24.49%. Correct, guys? So if distributions are made in cash, this is the case if distributions are made in cash. Okay. So 24.49% return of mutual fund. Now the second case is, instead of giving you this cash amount, which is 1.25 and 1 rupee, they are supposed giving you the units. Okay. So then what is the rate of return that you are making? So we'll say if distributions are made by additional units. If the distributions are made by additional units, then how are we going to get it, right? So first we will say we've got the number of units to be 300, right? Or we can say opening number of units. The opening number of units is 300. What is the amount of distribution per unit? Distribution per unit. So on each unit, what is the distribution? It is 1.25 as dividend and 1 as capital gain. So in total, the distribution is 2.25 rupees. Right? So 2.25 is the distribution per unit. So what will be the total amount of distribution? What's the total amount of distribution? Total amount distribution will be 2.25 into 300, which is 675 rupees. Now, when the company, the mutual fund is saying that we are not going to give you this 675 rupees as cash, but rather we will give you units against that. So, what will be the units which will be received as distribution? Units received as distribution. Cash will be 675 divided by 2.25, which will be 675 divided by 2.25, 300 units. Sorry, what is the price at which?
12.5 rupees.
Yeah. So each unit is being done by 12.5 rupees. So this will be like 675 divided by 12.5. So we would be receiving 54 units, right? So what will be the closing number of units? Closing number of units will be original 300 plus the new units given to us as distribution. So that will be 300 plus 54, which is 354. 354 is the number of units that we have. Now here when I want to compute the rate of return, I will compute the rate of return as simply closing value minus opening value divided by opening value. So closing value will be 354 multiplied by, what is the closing NAV? Closing NAV is 13. Right? Closing NAV is 13 minus opening NAV is 300 units multiplied by opening NAV value. Opening NAV was 12.25. Correct? 12.25, yeah. And then divided by 300 into 12.25. This will be 354 into 13 minus 300 into 12.25. And then this entire part will be divided by 300 into 12.25, which is 25.22%. So if distributions are made by form of additional units allotted to you, then it will be 25.22%. Is this calculation clear, everyone? Yep. Is this clear? Simple? Great. Great, guys. Now, we have this question number 5. Just read it and let me know if you can solve it. Can you solve this question? Question number 5. SBI mutual fund has an NAV of 8.5 at the beginning. At the end, it is 9.1. Meanwhile, the fund distributes 0.9 as dividend, 0.75 as capital gain. What is the fund's return during the year? Had these distributions been reinvested an average NAV of 8.75, assuming 200 units are purchased originally, what is the return? So I think you should be able to solve it. Come on, guys, quick. I'll just give you maybe 4 minutes to solve it. Come on, guys. Do it. Question number 5, quick. Yeah, do it. Question number 5. Okay, time up. So I think we should be able to get the answer. So what's the return in first case? Return on investment in case of cash distribution. So if it is cash distribution, is it 26.47%? And return on investment in case of units distribution. So in case of units distribution, it is 27.24%. Are we getting this, everyone? Similar to the previous question. Are we getting this? Yeah. Okay, fine. Then let's go for the next question, which is question number 6. The following information is extracted from steady mutual fund scheme. Asset value at the beginning of the month, it is 65.78. Annualized return is 15%. Okay, annualized return is 15%. Distributions made in the nature of income and capital gain per unit. It's this. And then we have calculate the month-end NAV of the mutual fund scheme and brief comment on the month-end NAV. Now we'll use the same formula for NAV which we have been using. Okay. This is our question number 6, right? Yeah, so return on mutual fund will be NAV 1 minus NAV 0 plus distributions. But this return is given as 15%, which is the annualized return. And the NAV that they've given us is for a typical month. So I can make 15% annualized to monthly return, 15% divided by 12. That's 15% divided by 12 should be equal to, we don't know what is the closing NAV. So NAV in year 1, we don't know. But we know the opening NAV is 65.78. Plus a distribution of 0.5 and 0.32. Divided by NAV 0. So NAV 0 is basically 65.78. Right. Now, can we solve this fully? Can we solve this and get the value of NAV 1? Yep. This is essentially like 15% divided by 12, which is 1.25%. So that's equal to NAV in year 1 or month 1. Then this will be like minus 65.78 plus 0.5 plus 0.32. This is divided by 65.78. Right. So NAV of month 1 will be equal to 65.78 78 multiplied by 1.25%. So NAV will be 65.78. Are we getting this NAV? Just do the calculation. Let me know, guys. Please check. Are we getting the NAV1 or NAV at the end of month to be 65.78 rupees? Yes. Okay. Then write a brief comment on the month end NAV. A brief comment about month end NAV. So what's the comment? We can say there is no change in NAV. Right? So there is like no change in the NAV of the fund. Simple. Okay. So there is no change in the NAV of the fund. Okay. Now, after this, that is done. Question 7. Then let's look at this question number 7, guys. Cinderella Mutual Fund has the following assets in the scheme. Rudolph, Cinderella Mutual Fund is having the following assets. So until 6, 5, 4, 3, 2, and 1. Yeah, Cinderella Mutual Fund has the following asset in the scheme Rudolph at the close of business on 31st March 2014. So there are 4 companies in which certain shares have been purchased at a given market price. The total number of units of Rudolph is 10 lakh. The scheme Rudolph has an accrued expense of 2,50,000 and other liabilities of 2 lakh. Calculate the NAV. So NAV can be simply computed by preparing the total of assets minus liabilities divided by number of units. So we'll say like the shares, and we have the number of shares, then we have the price, and then the amount. Shares are like Nairobi, Dakar, Senegal, and Cairo. We have number of shares as 25,000, 35,000, 29,000, and 40,000. Prices are given to us 20, 300, 380, and 500. So amount is number of shares into price, and then we take simply a total. So that's the total amount. Now this is the gross assets that we have. Right? This is the total assets. Of course, from that we need to subtract the liabilities. Now the liabilities will comprise of accrued expenses which we haven't paid yet, and will also include other liabilities. So accrued expenses 2,50,000. Other liabilities are 2 lakh, right? So we can get the net assets to be simply the total assets minus the liabilities. Right? So this is like 4,15,70,000 is the total assets. And then we'll say the number of units. So what's the number of units that we have? Number of units is 10 lakh, right? So NAV per unit, NAV per unit is, it's divided by 10 lakhs. That's 41.57. Simple, guys. Simple calculation. Right? Okay. Let's go for the next question. Question number 8. A mutual fund company has the following assets under it on the close of the business. So on the closing basis, we have the assets of the mutual fund as L, M, N, and P with the number of shares, and they have given the prices on 1st February and prices on 2nd February. The total number of units is 6 lakh. You have to compute the net asset value of the fund, and the information is given. Some additional information is given. So first we have to get the NAV of the fund. Now, how do we get the NAV of the fund? Which will be simply taking the total of all assets and divided minus any accrued expenses. So there's no accrued expense over here, right? So there's no accrued expense, and therefore the NAV is also going to remain. I mean, there's no liability which needs to be subtracted. Okay. So let's do this. Question number 8. Calculation of NAV as on 1st February. First February 2012. Calculation of NAV as on 1st February 2012. So we have company, number of shares, market price per share. So company is L Limited, M Limited, N Limited, P Limited. So number of shares is 20,000, 30,000, 20,000, and then 60,000. Market price is 20,312. I think this is the same market price, or no? It's a bit different. 20,312.4. And 12.4, and we have 361.20, 505.1. So we can say value wise, this number of shares into market price per share, right? Just multiply it and then take a sum of it, and then you divide it by a number of units. What's the number of units that we have?
6 lakhs.
6 lakhs. So we get the NAV per unit to be 78.84. Okay, 78.84 is the NAV per unit. Now additional information is given. Assuming one Mr. A submits a check of 30 lakh to mutual fund, and the fund manager of this company purchases 8,000 shares of M Limited and the balance amount is held in bank. In such case, what would be the position of the fund? And third case is the new NAV as on 2nd February. So this third case is actually giving us an information that we have to calculate everything for 1st February first, and then the 2nd February will be having a different value. So when this Mr. A is submitting a check of 30 lakh, what will be the new NAV calculation? So again, we'll have to do the calculation of NAV. We'll have to calculate it now for NAV as on 1st February 2012. Okay, 1st February 2012. 1st February 2012. After funds given by Mr. A. So where do you find the change happening here? Is L Limited going to change? Is the position of L Limited going to change? No. Is the position of M Limited going to change? Yes. In case of M Limited, we purchase additional 8,000 shares. So now it will be 38,000, right? But wait a moment. This 38,000 that has been there. So 8,000 is what has been subscribed for. We will still have some amount of cash left with us. What will be the value of the cash that we are still going to have? We have an investment of what? 30 lakhs. So out of 30 lakhs, we purchased 8,000 shares at a price of 312.4. Right. So the balance thing will be left by us as a cash portfolio. So this will be 30 lakhs minus 8,000 into 312.4. So 5,800,000 will be left as cash. 5,800,000 will be left as cash. So now the total assets that we have is, is like 5,03,02,000. Now, the number of units, is the number of units going to change?
Yes, 6,08,000.
Yes. No, it won't be 6,08,000. We purchased 8,000 shares of M. But what will be the units that we will be giving to Mr. A?
Sorry. I got it. My mistake.
Units to be allotted to A. What will be the number of units that will be allotted to A? Can I say it is 30 lakh divided by units to be allotted to A is going to be 30 lakh divided by the original NAV of 78.84. Because each of our unit was having a value of 78.84, and that needs to be divided by. So we can say the additional units that are allotted are 38,053. So number of units will be 6 lakh plus 38,053. So now obviously the NAV of the fund is still going to remain same because it is a price at which we have issued the units to the investors. Okay. Is this part clear, everyone? So number of units we need to recompute because new units are allotted to the new investor. Okay. Just a moment, guys. Okay. Yeah, Brakesh.
Sir, it's a 30 lakhs or we have some 5 lakhs is in cash. So,
Yeah.
and units will be 30 lakhs minus that amount or 30
No.
lakhs full?
No, it will be full amount because this money has been given to us, right, by the investor. So as the investor has given me 30 lakh, I will be giving him units which are worth 30 lakhs. So now out of that, I have invested some amount, but the mutual fund is retaining this 5,800,000 cash.
Okay, so mutual fund is retaining. Okay, okay.
Yeah. This cash is maintained by the mutual fund.
Okay, thank
Okay. Now the third part says find out the new NAV of the fund as on 2nd February. Now, what is going to change? This will be like calculation of NAV as on 2nd February. As on 2nd February, what's the NAV going to be? In case of 2nd February, the prices are basically changing. So I just need to change the prices and automatically the NAV will get computed. So for L, it will be 20.5, then it will be 360, then it will be 383.10, and then 503.9. Right. So this should be the answer for the NAV as on 2nd February. Yeah, you can just verify this. I'll just give you a minute's time. Just check out these numbers. I will be able to get the same NAV. Yeah, Prakash.
you. Question 1, 2, and 3 are in order. I mean, so for calculating question 3 answer, we should consider the
Question 2,
situation
yes.
in question
Yes.
2.
Yes.
Okay.
Okay. Are we all good, everyone? Yep. 82.26. Perfect. So we're done with question 3. Sorry, question 3, question 8. Now let's look for the next question, which is question number 9. Can we do this question 9? Just read it. Go through this question. Can you solve it quickly? I mean, whether you'll be able to solve it or not. Look at question number 9. Is it similar to previous one, right? Question 9 is very much similar to question number 8. So I think you can take this as homework. The same. So you can just take this as homework, question number 9. Let's go for question number 10 next. A has invested in 3 mutual fund schemes as per details below. So we have mutual fund A, B, and C. Date of investment is given as 1st of December 2009. Yeah, Brakesh Gudi.
Sir, in question number 9, timing has been given 4 p.m. So it is important with respect to the share bazar closing time. I mean,
closing
stock
time.
market
Yes.
closing.
They are the closing numbers. Yeah.
Okay.
Okay. You always consider the closing prices. So whenever we are computing NAV, NAV is computed on a daily basis, and that daily basis is looking at the closing prices of the securities.
3:30 p.m.
He has invested in 3 mutual fund scheme as per details below. So we have mutual fund A, B, C. We have the date of investment as 1/12/2009, 1/1/2010, and 1/3/2010. These are the dates on which the investments were made, right? And then we have the amount of investment made, net asset value at the entry date, dividend that we have received, right? And NAV as on 31st March 2010. So 31st March 2010, we have got the NAV. And then we have required to calculate, we're supposed to calculate the effective yield on per annum basis in respect of the three schemes to Mr. A up to 31st March 2010. Okay. That's question 10 now. So we have the NAV at the entry date given to us, and we also have the amount of investment. So let me have a proper format as particulars. Mutual fund A, mutual fund B, and mutual fund C. Mutual fund ABC. So we have like the amount of investment and the date of investment. So first, let us talk of the amount of investment. Amount of investment is 50,000, 1 lakh, and 50,000. Okay. Then we have NAV on the entry date. NAV on entry date. That's given as 10.5, 10, and 10. Right. So we need to get the number of units. The number of units is 50,000 divided by 10.5. And this is like, we have got the number of units. Then now, based on the number of units, we can say, what is the NAV on 31st March 2010? So NAV as on 31st March 2010 is 10.4. Then it is 10.1. And then it is 9.8. Right. So these are the NAVs given to us. Now we can get the value of investment as on 31st March 2010. So value of investment as on 31st March 2010. There will be number of units into NAV. Okay, so this is the value of investment that we have as on 31st March 2010. So we have the opening investment value, closing investment value, and then we have the dividend. Dividend received. So dividend that we are receiving. The dividend for mutual fund A is 950 rupees. For mutual fund B, it is 1500. And there's no dividend for the mutual fund C. So now we can get the return as simply value in current value minus the opening value plus the dividend, and then this entire portion divided by value of your investment, which is reasonable. So I can say it is simply value of investment, closing value of investment plus the dividend minus the opening value of dividend, minus the opening value of investment divided by the opening investment. So percentage wise, it is 0.95%. 2.5% and minus 2%. Can we really compare these three returns? Can we compare these three returns and state which of these are having, or which of these mutual funds have performed better?
B.
No, we cannot compare because the date of investment is different, right? Because over here, date of investment is different. I cannot compare it. So we'll have to look at date of investment and date of, or I can say current date. So date of investment is, first case it is 1/12/2009. Second it is 1st of January 2010. Then it is 1st of March 2010. Right, so 1st of March 2010, and current date that we have, current date that we are on is 31st of March 2010. So this is the return that we have earned for different tenures. So the tenures are different, guys. So for each of them, we can say the tenure is different, and therefore I cannot compare these numbers. So I'll need the number of days or days of investment. Yeah. Get the days of investment, guys. What is the number of days for which investment was made in case of first mutual fund? It was done on 1st of December 2009, and now we are standing on 31st of March 2010. How many days? So it is like December, we have got 31 days, right? Plus January 31 days, plus February 28 days, and plus March 31 days. So total is 121 days. Same way, what's the number of days for the second investment? 31 days of Jan plus 28 plus 31. So that's 90. And here it is 31 days. So of course, this 0.95% is the 0.95% return for 121 days. This 2.5% is the return for 90 days. And this negative 2% is the return for 31 days. So I need to get the annualized yield. So annualized yield will be 0.95% is for 121 days. So for 365, what should be the return? Yeah, so this is how we compute the annualized yield. Right, guys? Are we getting these annualized yield numbers? So I need to convert. I cannot compare these returns. I cannot compare these returns because the returns are for different tenures, and therefore, to make it comparable, we have to make it an annualized numbers. Okay. So now, out of these three mutual fund, which fund has actually performed better for the investor? Of course, it's mutual fund B. It's mutual fund B which has given the highest return. Okay. So that's about this question number 10. Then Question number 10 is done. Look at question number 11. Mr. Sinha has invested 3 mutual fund scheme as per the details below. The date of investment is given, amount of investment is given, net asset value is given, distributions are given, NAV as on 31st of March 2009 is given. You are required to calculate the effective yield on per annum basis in respect of each of these 3 schemes to Mr. Sinha up to 31st of March 2009. Can you say it's just similar to question number 10?
Yes, same.
Same. Just few numbers here and there. Right? It is almost same. So can we take that as homework? Yeah. Yes, that's similar numbers. Now, still have like few minutes left. Let's look at this question number 12. Mr. Y has invested in 3 mutual funds as per the following details. So 3 schemes, again the amount of investment is given. NAV at the time of purchase is given. Dividends that have been received up to 31st March is given. And then we have NAV as on 31st March 2018 as 10.25, 10 and 10.2. Effective yield. So on a per annum basis, what is the return? That's given over here, that's specified over here. Then we have Mr. Y has misplaced the documents of his investment. Help him find the date of original investment after ascertaining the following. First, the number of units in each scheme, total NAV, total yield, and the number of days for which investment has been held. So we have to do a bit of reverse calculation over here. Okay, so we need to do a bit of reverse calculation, but yes, the form is going to be on this similar lines. So I'm just taking it over here. Yeah, this is question number 12. Okay, let's start. The amount of investment in, of course, the name of mutual funds is X, Y, and Z. This is mutual fund X, this is mutual fund Y, and this is mutual fund Z. So amount of investment is 2 lakh, 4 lakh, and 2 lakhs. NAV on the entry date at the time of purchase, the NAV was 10.3. 10.1 and 10. Right. So we automatically get the number of units because we already have seen this type of question. Couple of questions we have done. So I'm just taking it at a faster pace. So we simply divide the amount of investment with the NAV on entry date. So we get the NAV, the number of units. So now NAV on 31st of March is given as 10.25, 10 and 10.2. So 10.25, 10 and 10.2. So value of our investment as on the date, as on which date is it? As on 31st of March 2018. So as on 31st of March 2018, these are the value of investment. The amount of dividend that has been received is also specified, 6,000, 0 and 5,000. 6,000, 0 and 5,000. And they have given us the effective annual yield. Now, of course, we got this return for a specified number of a certain number of days, but they have given us the annualized yield. So in this question, they have given us the annualized yield. So annualized yield is 9.66%. And then we have minus 11.66% and 24.15%. Okay. So, we want to essentially calculate the total number of units in each scheme. That is done. Total NAV is done. Total yield is also done. Then number of days investment held. Want to compute the number of days for which investment is held. So days of investment, you can simply calculate it as this 2.51% is for that particular tenure, which translates to 9.66. So we can say 2.51 divided by 9.66 into 365. So you multiply this by 365. So that essentially should give you the number of days to be 95 days in the first case, because we are just computing the number of days. So it will be like 2.51, or I can say this is computed as return upon annualized yield multiplied by 365, right? So it is 95 days, and then it is 31 and 68 days. So you can just do the backward calculation and get the date of investment also, because we are valuing it as on 31st of March 2018. So you can do the backward calculation and get the original investment date, right? So original investment, this is as on 31st of March 2018. So we can get the date of investment by simply doing the backward calculation. So it is 31st of March 2018. Let's take it as 95 days back. So it will be like 31 days of March, right? Then we are left with, like, from this you subtract 31 days of March. Then again you subtract 28 days of February. Again you subtract 31 days of January. You're still left with 5 more days. So you subtract 5 days from the month of December, right? So subtracting 5 days from the month of December, that should be giving you answer as 26th of December 2017, right? And same way the other dates are going to be, like, since it is 31, you can say 1st of March, or 1st of March 2017, 2018. And since this is 68 days, you can say it is 22nd of January 2018. This should be your date of investment. Just do the backward calculation to get the dates. Okay. So I hope this question makes sense for you. So you've done, like, good number of questions in today's class. If you have any queries, then you can proceed, or else we'll just call it a day.
Student, do you have any queries?
No, sir.
Student, actually, since the assignment have been just now been uploaded, okay, but see, since the questions are the same of the study module, so you can get these same numbering. Even numbering is the same. Okay, there is no problem for that, even if you could not download the assignment. Okay, student. Now, in today's class, Jagbandhu sir has discussed the concept of reverse calculation. Now, I tell you a very, very, very good incident. Actually, if we talk about the reverse calculation, I think in this old scheme, in May 2018, there was a question in which everything was the same as from the study module. Only thing is that they have this is the answer. They have given the answer and they have asked you for how many days the investment has been made. It was the first time. So students said, sir, it is out of syllabus. No, it was not out of syllabus. It is only the concept testing. And this concept testing is normally done in the case of mutual fund through the reverse calculation, which Jagbandhu sir has explained in a good manner. So Jagbandhu sir, I think in next class, this topic will be completed.
Yes, it will be done.
Okay, student, in the next class, we shall complete this topic and you discuss, you revise the whatever discussed in today's class. And students, see, there are one topic, security analysis, whose classes have not been yet conducted. It will be conducted in the last. Okay, so don't worry. It is a part of your syllabus. So don't forget, don't say it is not a part of your syllabus. It is a part of syllabus. Of course, we will cover it in the And okay, Divas sir, Jagbandhu sir, just show in the telephone number as well as the email ID. Okay, 3045 956 SFM-final @ICAI.in. Okay, student, if you have any query, you can send it as through the mobile app, or you can send it at this email ID, or even you can contact me over the telephone. Okay, student, thanks for patient listening, and see you in the next class. And Jagbandhu sir, thank you very much for sparing your precious time and enlightening the student on this topic. Thank you very much. Yeah.